Hey, my name is Tucker Krause, and welcome back to my channel, and today's video, I got another stock analysis for you guys, so let's get right into it. But first, if you didn't see my short that I put out last week on going along a loan crisis, go watch that, then come right back here, because that'll kind of put this video into more context. Without it, you might be kind of a little confused as to what I'm talking about here, because you might not have all the info, though there's also a good chance, of course, you guys, I'm hoping that you guys all do your own research. Of course, this is not financial advice, that you would have maybe also seen this on your own, but either way, I would still go check out that short, so go watch it. Alright, you watched it, you're back, or maybe you just sat through that awkward pause because you already seen it. Alright, so Altisource Portfolio Solutions, ASPS, it trades with the share price $12.44 with a market cap of $199.749 million with a PE of 8.46 and no dividend. And this is all on the New York Stock Exchange as of July 18th. So pretty low PE ratio as well as a very small market cap, so lots of room for growth. Let's get right into the charts. Alright, so this is their 1-year chart. We can see here they've kind of just been in this pattern here since about October, slowly declining after we jumped up massively here once again in October. And so we've hit our head 1, 2, 3, 4 times here, bounced off the bottom 1, just about 2, 3 times here, and so it looks like we're coming in for another attempt at a breakout, so we're really gonna have to watch if this breaks out. I think that'll be interesting when we come in with their earnings being on July 28th as well, so we'll have to see what happens here. If we get a big pin right here or something, or a big bearish engulfing right here on, Tuesday or Wednesday this week or something like that, then we could be falling a good bit, though we could also rocket a good bit if we manage to get another giant green candlestick right through this resistance line. Now, looking at their all chart, we can see that this kind of goes with that going along the loan crisis short I put out that I asked you to watch earlier if you had missed it. And so we can see here that, once again, coming out of the great financial crisis, they went public in 2009. They went crazy, but ever since then, they've just been slowly bleeding off. Alright, so let's look at a couple of slides from their presentation, so I'll just read through some of them here. Comprehensive suite of solutions, servicer and real estate segment. So loan servicers providing a suite of options that support the default servicings of loan management and disposition of homes. So pre-foreclosure, foreclosure management, and disposition. So this is just all their products for each of those segments. As well as for real estate investors, developing a suite of solutions leveraging the offerings provided to loan services, due diligence and acquisition, management, and disposition. So they do everything with real estate. Then also looking at their origination segments, so mortgage originators providing a suite of solutions to help loan originators, primarily lender one members, better compete. So loan manufacturing, capital markets, and business operation engagement and data. So, their services will help people, get loans, create mortgages, all those sort of things, as well as foreclose on houses and those sort of things. Alright, so compelling growth catalyst. So looking at their servicer and real estate segment, tailwinds from the restart of residential default market, counter-cyclical business that generally benefits from a deteriorating economic environment, as we saw from their alt chart there earlier, as well as large white space opportunity to display established opportunities, purchased by servicers to the growing single-family rental market. Now, the origination segment, increasing demand for our solutions that help reduce costs in a low origination and tightening margin environment, right, of course, is interest rates go up and those sort of things. Then, tremendous compounding growth opportunity fueled by strong network effect. So, of course, you can see that just the way they're talking about, they're clearly focused on here. They see foreclosures, defaults potentially going up as interest rates go up and the cost of living goes up with inflation and all of those sorts of things, and their services support that, so therefore they of course benefit from that. Alright, so tailwinds from the restart of the residential default market. So it's a little bit tough to see here. It's pretty small. I can barely see it actually. We can see that while everything was paused, everything of course collapsed down very, very low with foreclosures, although as soon as that came off, they rapidly climbed again. So foreclosure moratoriums and temporary loss mitigations measured reduced U.S. foreclosure initiations from Q2 2020 to Q4 2021 on average by 87% compared to Q4 2019, and these measures largely expired at the end of 2021. In Q1 2022, U.S. foreclosures initiations increased 430% compared to the average for the previous 7 quarters, which we see right here, and we anticipate REO inventory depleted from March 2020 through December 2021 to reach stabilized levels in mid-2023, and once again countercyclical business that benefits from a deteriorating economic environment. And so we can see right here that unemployment and mortgage delinquencies, we can see like right here, for example, in 2007, 2009, we can see once everything went really poorly, of course, that's going to show that the unemployment rate goes up as well as the delinquency rate going up. And so, of course, they're going to benefit off that delinquency rate, right? We can see here, delinquency rates typically rise in a recessionary environment. Our servicer and real estate segments provide solutions to servicers across the delinquency lifecycle. We estimate for every 1% increase in the 30-day delinquency rate, the addressable market for default-related service increased by $700 million. So it's not like we even need a massive, crazy crash like 2008 for these guys to start bringing in a whole lot more cash than they have in the past few years. Alright, compelling growth catalyst, origination segment, increasing demand for solutions that help reduce costs in lower origination and tightening margin environments. So the shaded is the forecasted period, and so we can see as mortgage rates goes up, there's less mortgage originations because of course less people are out here buying homes. So residential loan originators are facing an increasingly challenging operating environment with lower origination volumes and margin compression. As a result, we believe originators are focused on cost reductions. Many of our solutions help small and mid-sized lenders better compete by reducing loan manufacturing costs and improving operational efficiencies. In this environment, we anticipate benefiting from the growing demand of our solutions that should result in a certain solutions declining at slower pace than the market origination volume, and in some instances remaining flat or growing. Alright, path to positive cash flow. Improving operating environment and sales wins on a lower cost basis provides a path to positive cash flow, so leveraging lower cost base as a revenue grows. So reduce Q1 2022 cash operating costs by $13.6 million, representing a 31% savings from the previous quarter last year. Growing revenue, so sequential revenue growth in Q1 2022 for the first time in 11 quarters, tailwinds in the servicers and real estate segment from the exploration of governmental foreclosure moratoriums and temporary loss mitigation measures. Countercyclical servicer and real estate segment should benefit from a rising delinquency rate environment. Origination segment should benefit from increasing customer focus on reducing costs and new product launches. And improving business segment adjusted EBITDA margin, so anticipated revenue growth and efficiency initiatives in certain business units should improve business segment adjusted EBITDA margin. So Q1 2022 adjusted EBITDA margin, we see that it's 25% for this one, servicer and real estate, and then origination is 0%, and then we see them expect that to climb to 40 and 22% respectively in 2024. So it's a capital light business model that should generate strong operating cash flow once revenue sufficiently to benefit from scale, and we see that with the capital light because their free cash flows, we'll get into in just a second, has regularly been higher than their net income, meaning they're just bringing in a whole lot of cash. And so they didn't actually show their ownership, so I just took this off of Simply Wall Street. So individual insiders, 10%. So that's really high. I love to see that. That's great. And the CEO himself owns 3.5% of the company. So overall, I really like the share structure here. Not to mention, it's just a lower share count overall. They're not diluting like crazy, despite the fact that their, net income and free cash flow has been falling for like half a decade now, which let's get into it now because we just did a whole lot of reading. So let's get into some more numbers. Alright, so Asps Revenue. So we can see this goes back as far as I could possibly find, though I should note they went public in 2009, so that for 2007, 2008, and 2009 numbers, do just know that. We can see between 2014 and 2007 that their revenue grew by 35% on average year over year. We can see that's where it peaked out 2014. Ever since then, it's just been falling. And so that's averaged out to just 2% over the past roughly 15 years. And so, of course, if we see this potentially start to tick up again and grow, that's going to mean big things for the company. Perhaps, it's starting to look like this, because right now our revenue is actually pretty close to where it was 2007, which is before everything started to break like crazy for the most part. Though some things were already starting to break 2007, not everything though. Alright, so net income looks very, very different. So since 2018, we haven't been profitable. Well, not we, ASPS, I should say. And 2021, they did just barely come out to positive. No, this looks a little bit different from their revenue. We can see 2017 had a weird, extraordinary item come in. So 2017, we see a massive jump here, even though their revenue was actually lower than 2014, whereas their net income reads as significantly higher. But we can see overall, the pattern's basically the same. And trailing 12 months net income is 21,624. So profit margin seems to be rapidly improving, right? That's double 2021. And so overall, once again, 53% average year-over-year net income growth between 2007 and 2014, and since then, just declining for the most part. Now, free cash flow, this is what I mean by they generate a whole bunch of cash. This was their fastest growing of the three between 2007 and 2014, growing by 67.9% per year on average, which is crazy. So once again, clearly they generate a ton of cash flow, often well above their net income, and it only became negative in 2020, so clearly they're bringing a lot of cash. Though, of course, since it was negative here, we can't necessarily see what the growth rate was over these whole 15 years. Whereas net income and revenue, we could see that. So, once again, looking at free cash flow, we can see that it follows, once again, a similar pattern, though a bit choppier, up peaking here roughly in the early to mid-2010s, and falling ever since. So, if we can kick back even just to being positive, that's going to do numbers for the share price. Not to mention if we start growing like crazy. Alright, so looking at some of the management numbers, so things like return on invested capital, return on equity, of course, greatly negative because that's what their net income's been. And so when we look at debt to earnings ratio, they do also have quite a bit of debt, though that's not necessarily to say that's fair when you're looking at a debt to earnings ratio because they don't really have any earnings to pay that debt off with, or they just barely do, I should say. And their quick ratio, though, is actually pretty good, and that's at 2.41, so overall, not great numbers here, but that of course makes sense because their business has been growing for so long. So to look at their DCF here, we can see that overall it actually looks surprisingly good, which you might be, wait, how does this look good? Everything else looked pretty bad looking at the numbers. Well, it's pretty simple to explain. So I just took analyst estimates for free cash flow in 2022 and 2023, put them in a DCF, and then projected out for 2024 and 2025 with 25% free cash flow growth each year. And of course, when we look back here, it was 67%. So it's not like I'm getting too crazy. The slowest growing revenue was only at 35%. Well, not only, that's still crazy fast. So 25%, I think if we do see a situation where foreclosures rise rapidly, interest rates are rising and just killing the housing market, that 25% is pretty reasonable. And so that's why, just my explanation for the numbers here, despite the rest of the numbers looking pretty bad. So we can see that at a 10% discount rate, it's basically at fair value. At an 8% discount rate or their WACC, there's actually a decent amount of upside here. And so, of course, the share price go parabolic way beyond their fair value as well if, everything just goes terribly in the housing market. Though, of course, could be worth it to look in some other companies that have maybe done a little bit better over the past couple of years to see that, maybe they're not in as much debt and these sort of things. And geez, that was a long video. Overall, though, tough to say. Of course, once again, this is not financial advice. Do your own research. Thanks for watching, and I will see you next time.